Hello guys. How are you? I hope you are fine. I am the ACCA tutor, Mr. Jeremy Timkulu, and in this video, I'm going to take you through uh, gain or loss on disposal. That is, we are continuing a step further in our lecture on consolidated financial statements. Okay, so in the course of uh, the group relationship, the parent might decide that it is now time to call it quits with the subsidiary. So there comes a time when the parent just decides to dispose of the subsidiary or of its control in the subsidiary. But in the ACCA paper financial reporting, the assumption is that the disposal is on the entire shareholding. Okay, so you're going to be tested on disposals involving um, the release or the disposal of the entire shareholding. That is, if the parent had acquired, say, 70% or 80% of the subsidiary's shares, equity shareholding, then um, the assumption is that when the time comes for disposal, all the 70% or the 80%, whichever the case might be, will be disposed of. All right, good. So as you can see on the screen there, we've got two instances when we will be required to calculate the profit or loss on disposal. Sometimes the examiner might ask you to calculate the loss or gain on disposal in the, to record that transaction in the parent's records or in the group's accounts. So you should be able to compute both uh, figures. All right. So the formula, if you are required to record the loss or gain on disposal, is in the parent's records, is given on the left side. That is uh, cash received less investment sold. That's how you get the gain or loss on disposal. On the other hand, if you are to record in the group accounts, then you should say cash received, add any investment retained, less net assets at disposal, plus goodwill at disposal, less NCI at disposal. And then you get that figure and then the gain or loss on disposal. However, since the assumption is that at the ACCA financial reporting level, you are not going to be tested on partial disposals, but full disposals, then it means that this part of the formula, let me try to annotate, this part is going to be irrelevant to you. Okay, that is for this level, right? Because the assumption is that the parent is going to dispose of everything they own in the subsidiary. Remember, we are talking of disposal of subsidiary shareholding and not disposal of equities in associates and so forth. We are talking of disposal of companies which were being controlled by us, which we call subsidiaries. That's when you need to calculate the gain or loss on disposal. All right, so let us look at a worked example to see or to illustrate this point further. This example has been adopted from the BPP revision kit. Okay, now Foco owns an 80% investment in Spoon Co, which it purchased. Excuse me, there is a phone call. I'm sorry for the disturbance. Okay, continuing. Foco owns an 80% investment in Spoonco, which it purchased several years ago. The goodwill on acquisition was valued at 1.674 million, and there's been no impairment of that goodwill since the date of acquisition. On 3rd September 2024, Foco disposed of its entire investment in Spoonco, details of which are as follows. Sales proceeds of Foco's entire investment in Spoonco, 5.580. So that was the consideration which was received when upon disposal of Spoonco. Cost of Foco's entire investment in Spoonco, right? The cost of the entire investment when the subsidiary was acquired. Immediately before the disposal, the consolidated financial statements of Foco included the following amounts in respect of Spoonco. Carrying amount of the net assets, excluding goodwill, that's 4.464 million. Carrying amount of the non-controlling interest, 0.9 million. Now, the question: what is the profit or loss on disposal before tax, which will be recorded in Foco's consolidated statement of profit or loss for the year ended 3rd September 2024? Okay, so the statement before tax simply is telling you that you need not to worry about any taxation impact on the sale of the disposal. Just have to ignore taxation for now. Okay, so we now have our formula at the back of the mind. But one thing we need to understand is that which of the two formulas are we going to pick? Here, the examiner wants us to determine the profit or loss in the consolidated statement of profit or loss. So we are being asked to compute the gain or loss in the group's accounts. All right, so we know the formula that gain or loss is given by the consideration received, or proceeds, actually, the proceeds of the sale, all right, less net assets of the subsidiary on disposal. Okay, less goodwill of the sub on disposal, less NCI. Okay, the NCI on disposal. So on goodwill, you then have to assess if the goodwill had been impaired since the date of acquisition. All right, because sometimes the examiner might give you the goodwill figure there, but he then points out that the goodwill has been impaired by so much. So in this case, we are lucky. We have been told that there's been no impairment. So let us then slot in the figures in our formula. All right, here, when I said for the NCI, I don't want you to be confused. All right, the formula should actually, let me take you back. I'm sure you are seeing how the formula is structured. There is this less. That less is a high profile deduction operation, in the sense that you need to first of all take care of these items in the box. So what it means is that If you didn't want to put the single less there, it means that you were going to proceed as follows. We're just going to say cash received X, all right, less net assets at disposal, and then less goodwill at disposal again. All right, so which means this one was going to be negative, this one negative. However, now you were now supposed to say when you arrive at the NCI at disposal, you need not to say less, because if you say less, the impact will be very, very different and wrong. So for it to be correct, you then have to say add NCI at disposal. So which means the NCI there should be positive. Otherwise, if you want to use the less NCI there, then you just have to go with the single less on top there. I'm sure I'm talking to somebody. Remember the impact of these items in the box. So the formula is a bit challenging there, but you're not going to be confused. I know that. I count on you guys. So here we are going to say the NCI there is going to be, we add NCI there, okay, for us to arrive at the figures correctly. So how much was received? All right, so the proceeds were 5580. Remember, you need to tell the examiners that your figures are in thousands. All right, then less the net assets on disposal. So the net assets on disposal were 4464. These are in brackets. And then the goodwill on disposal. The goodwill on acquisition was 1.674. Then the NCI is a positive 900. So what will be our answer there if we compute the figures nicely? Let me look for the calculator. 5580 minus 4464 minus 1674 plus 900, 342. So which means our answer should be C. Okay, now let us try to use the other formula as shown there. Suppose we just say the proceeds is just the same as consideration received. Proceeds in thousands. The proceeds were 5580. Okay, less, we just want to put one less there. Less net assets. Let's start with the net assets on disposal. The net assets on disposal were 4464. All right, then the goodwill on disposal 1674. Then NCI on disposal was how much? 900. This time, then NCI, given the formula here, is if we use one less here, it means the NCI should then be negative, as you can see there. So the NCI is now negative. So we come here and say NCI, our NCI should be negative. All right. Why is it negative there? Because we have got the less, the single less here. The impact of that less is that it will turn the negative NCI into a positive figure. All right, minus minus, something like that. Okay, so what is the total figure then? 4464 plus 1674 minus 900. That's we get 5238. And remember, we have got a less here, so this ultimate figure is a negative figure. Am I talking sense to you? Okay, so we say 5238 from 5580, we get our 342 as the gain on disposal. Are we together? So I've done justice. I've shown you both workings. Okay, for the benefit of our learning, I think we need to then look at another question structure that is as well relevant to the ACCA paper financial reporting. This time we are going to look at a typical section B type question, which you are highly likely to face in your upcoming examination. So let us go straight using the same source, that is the BPP revision kit. We have managed to come up with this particular question, which we think would be very beneficial to you. Okay, so as I've indicated, this is a very rich exam ground, and students always find themselves entrapped and falling victims. So please, you need to be able to assimilate and jiggle the exam content. This type of content, you need to be able to shackle it, so that on exam day you're not going to be found on the wrong side. Okay, so be able to manage it. Let's move on to, sometimes this screen sticks. All right, there's this particular question, ladies and gentlemen, that is from root core. It is from the BPP start text. Root core. Okay, maybe it's an error. It seems like it's a revision kit, but anyway, that doesn't matter. On 1 April 2007, Root acquired 116 million of branch's 145 million ordinary shares for an immediate cash payment of 210 million. So they acquired how many shares? They acquired 116 million of 1.45 million. So what was the percentage? Acquired 1116 over 145 multiplied by 100%. This should be how much? Let me use my calculator here. 116 over 145, that's 80%. So therefore NCI is equal to 20%. That's the group structure. That's your working number one, the standard working number one. They also, on top of that, so this was the cash payment. All right, the cash payment was 210 million. Okay, and issued again, they issued at par 10% $100 loan note for every 200 shares acquired. So the loan note consideration are loan note consideration was equal to 100. All right, thanks, Mama. Thank you. Thank you. 100 over 200 multiplied by multiplied by 116 shares, 116 million. So that should be, let me see, 100 over 200 multiplied by 116. That's 58 million. That's 58,000 if we are using if we are presenting the information in thousands. So the total consideration, what is the total consideration? Because our question requirement number 1 is saying what is the total amount of consideration transferred to acquire the investment in branch. So you can see that the total should be the 200 million there, 210,000 plus 58,000. This should be 79,000. Okay, but I said if we are presenting in thousands. However, in this case, the examiner has said that you need to input a figure that speaks of millions. So obviously, you're not going to put 79,000 like this because the tutor is saying 79,000. No, it doesn't work like that. Okay, you need to be very, very careful when you present your solutions. You need only to put 79 only. Just input, you just have to punch in 79 on the portion, the answer portion given. 79. However, the examiners they might have given a leeway for certain students who are very arrogant. They might just want to type in, the 7. That shows that you are not yet ready. You want to type the amount in words. Sometimes that doesn't augur. That doesn't sound good, because as you can see, everything is being given in figures. They even the 210 million there was two. They were figures 210, and then the million has been given the answer portion. So which means you just have to follow the same format. You just have to type in the exact figure 79, and not to type to type it in words. I'm sure you get it. You got me, guys. This is a serious exam, and people simply fail or because of these silly mistakes. So you need to avoid that. Those terrible blunders. Okay. All right. I just want to correct something here. The addition is not actually adding up. Okay, this is 210, right? Plus 58. It can't be 79. Okay, that one is a very terrible one. Okay, I'm very sorry there. It's 210 plus 58. Let me just punch. It's not good to use mental work sometimes. All right, so it actually comes to 268. I'm sorry there. Please forgive me. Don't begrudge your tutor. So it's 268 million. All right. Let's proceed with the scenario. So sometimes you just have to, when you read the first paragraph, then you have to go to the question requirements, because you won't be having enough time, all the time to do the jigsaw puzzle. You just have to go straight and nail and ask the question as you'll be proceeding reading the scenario. All right, so the second requirement is saying what will be the amount of the adjustment to the group retained earnings at 31st March 2029 in respect of the movement on the fair value adjustments. Okay, so when the examiner is testing you on movements, think of movements usually apply to items which are reported in the statement of profit or loss. So in that case, you need also to be wary of the dates. We are talking of the reporting date of 31 March 2009, and this subsidiary was acquired on 1 April 2007. So we are talking of 2 years, movement of 2 years, 2 years later. Okay, so let's now look at those items which require fair value movement. So let's read paragraph number 2. At the date of acquisition, branch owned a recently built property that was carried at its depreciated construction cost of 62 million. So this was the carrying amount. Okay, carrying amount. The fair value of this property at the date of acquisition was 82, and this is the fair value. So if carrying amount was 62 and fair value was 82, so which means we need to uplift this property by how much? 82 minus 62, we are looking at 20 million fair value uplift. However, we also have to consider the depreciation, what we call the excess depreciation. Here we are looking at 20 years. The property still has, it has had, when it was acquired on 1 April 2007, it had a remaining life of 20 years. So it's now 2 years later. Okay, 2 years later, it means that it has suffered some depreciation. So how much was it being charged in terms of depreciation? It was being charged 20 million over 20 years. That means it was being charged 1 million every year of depreciation times number of years up to date, which means we are talking of 2 years. So the depreciation charge should be 2 million, and that is part of the of the themes which affect the retained earnings. Remember, retained earnings are reduced by depreciation. Depreciation is one of those items which reduce the figure, because the question is saying what will be the amount of adjustment to the group retained earnings. So obviously we found one. The excess depreciation needs to be catered for. All right. The fair value uplift was not going to affect the group retained earnings. Why? Because the fair value uplift only affected the revaluation reserve, but at the date of acquisition, it was actually in addition to the value of the net assets at acquisition. Okay, but it's not part of the adjustments, the post-acquisition adjustments. Here we are looking at post-acquisition adjustments, which are relevant, which are going to affect our retained earnings figure. Okay, so don't confuse the two. Now let's read another one. Branch also had an internally developed branch which was valued at the acquisition date at 25 million and with a remaining life of 10 years. So this branch was a branch, or was an intangible asset with a definite life. So if it is if it is an asset, an intangible asset with a definite life, then it should be amortized annually. All right, so the amortization is now 25 over 10. So which means every year we charge 2.5 million of amortization. Okay, the depreciation of intangible assets is called amortization. So every year, but now it's now 2 years later, times 2 years. So it means that the adjustment to our group retained earnings should be 5 million. That's the excess amortization, 5 million. So the total adjustment should be 2 million plus 5 million. This comes to 7 million. So what is our answer? Our answer is A. So you can see that this is not rocket science. However, you need to be very alert and skeptical as you'll be attempting these questions, because there are a lot of pitfalls which students are likely to face along the journey. Okay, so this is why you need a tutor by your side, because if you have a tutor, you'll be going to be very, very safe as you will be proceeding with all these ACCA, modules. All right, let's proceed with our discussion. What is the amount of the unrealized profit arising from intragroup trading? So here we just have to go to that part of the question that speaks of intragroup trading, because in the exam you're not going to be having a lot of, all this time reading everything like a storybook. All right, so I think this is the paragraph that talks of the intragroup. The inventory of branch at 31 March 2009 includes goods supplied by Root for a sale price of 56 million. So there were inventories which had been supplied at a price of 56 million. So as you can see, we said we are only worried about that inventory that has not been sold to third parties. So this inventory had been there within the company, although it has been sold by the parent to the subsidiary. Right? So if it has been sold by the parent to the subsidiary, we know that the double entry is debit cost of sales and credit stock. We need to increase the cost of sales, but reducing the stock or the inventory with the amount of the PAP, or the UP, the unrealized profit. But now let us compute the unrealized profit. We are told that the parent adds a markup of 40% on cost of sales. So within these 56 million, there has been a 40% markup. So that means that our UP should be 40 over 140 multiplied by 56. And what do we get, ladies and gentlemen? Okay, 40 over 140 multiplied by 56. So we are looking at the PAP of 16 million. So we come here and say this was 16 million. I want you guys to pass this paper, the ACCA financial reporting paper, with a straight 90% and above. Okay, just 90% and above. There is actually no need for you to rewrite this paper. It's actually a giveaway paper. All right. Number 4, how should the unrealized profit be posted? So you can see here that our answer, as we have already indicated there, is A. We debit cost of sales and credit inventories. Why? Because it is the parent that sold to the subsidiary. However, if it was the subsidiary that sold to the parent, therefore, in that case, you're going to adopt B. But in this case, it is the parent that sold the goods. So our answer remains A. Okay, the last question. Branch has recently lost some large contracts, and the directors of Root are wondering if this branch or this subsidiary can be excluded from consolidation next year. We have already pointed in our series, the consolidation series, related to this series again, our first video actually, we indicated that there are conditions, but these are limited, right? And from the choices given, there is only one condition that you need to consider for you to say, I'm no longer consolidating a subsidiary. And that is only and only when you lose control of that subsidiary. If that subsidiary is still within your control, then you need to consolidate it, even if it is a loss making, or even if it is now operating in a very different industry. You are required to consolidate that subsidiary. So the answer there is when the control of the subsidiary has been lost. If you lose control, then you are allowed not to consolidate it. Ladies and gentlemen, I hope I have done justice to you. All right, if you feel you need my coaching or my tutoring, please just say hello on my WhatsApp number, that is plus 263 774 596 368, or simply email transcarlex@gmail.com. I'll be there and ready to entertain you. This is why I am there. Until next time, ladies and gentlemen, please continue to feel excited. And I mean it, very, very excited. I'm signing out.